Introduction. Money is often thought of as a means to an end. But what if wealth, true wealth, starts not with what's in your bank account, but with what's in your mind? Today, we'll explore how your psychology shapes your financial reality and how changing your mindset can help you build lasting wealth. For centuries, the idea of wealth has been synonymous with material possessions. But as we'll see in the next few hours, the psychology of wealth is far more than just dollars and cents. It's about how you perceive the world, how you approach opportunities, and, perhaps most importantly, how you think about yourself in relation to money. Research shows that wealthy individuals think differently about money than the average person. They adopt what's known as an abundance mindset, a belief that opportunities are limitless and that wealth is a natural outcome of the right habits and decisions. But not everyone thinks this way. In fact, many people live their lives trapped in what we call a scarcity mindset, the belief that resources are finite, that there's never enough, and that opportunities are limited. This mindset leads to decisions based on fear. Fear of losing money, fear of missing out, fear of not being enough. Developing a wealthy mindset is about more than just thinking positive. It's about taking deliberate actions that align with your vision of the future. In the next several hours, we'll break down the psychological foundations of wealth, exploring how you can shift your mindset, build healthier habits, and take control of your financial destiny. Part 1. The scarcity versus abundance mindset. The scarcity mindset tells you that there isn't enough to go around. It whispers that every dollar is in short supply, that success is limited to a select few, and that you're always in competition with others for resources. People with a scarcity mindset often hoard their money, avoid taking risks, and make decisions out of fear. They constantly worry that they'll never have enough, and this fear influences every financial decision they make. In contrast, the abundance mindset teaches you that opportunities are everywhere. It's the belief that there is plenty of wealth, success, and opportunities to go around. When you adopt an abundance mindset, you're more willing to take risks, invest in your future, and share your wealth with others. This mindset allows you to see potential where others see obstacles. One of the key differences between the two mindsets is how they approach opportunities. A scarcity mindset sees every opportunity as a zero-sum game. If someone else wins, it means you lose. But an abundance mindset understands that there is always room for more success, that one person's win doesn't mean your loss, and that collaboration often leads to better outcomes for everyone involved. Shifting from a scarcity mindset to an abundance mindset isn't easy, but it's possible. It starts with changing how you think about money and opportunities. Instead of focusing on what you don't have, focus on what you can create. Instead of worrying about losing money, think about how you can invest it in ways that grow your wealth. The next time you face a financial decision, ask yourself whether you're acting out of fear or abundance. Are you hoarding your money because you're afraid of losing it? Or are you investing it in opportunities that will bring you closer to your financial goals? Adopting an abundance mindset doesn't mean throwing caution to the wind. It means recognizing that opportunities are abundant and that with the right strategies, you can always find a way to grow your wealth. Delayed gratification and self-discipline. One of the most important traits of wealthy individuals is their ability to delay gratification. In a world where everything is designed for immediate pleasure, from fast food to fast loans, the wealthy practice patience. They understand that the biggest rewards often come after a long period of disciplined effort. The famous marshmallow test conducted in the 1970s is a great example of this concept. Children were given the choice between one marshmallow now or two marshmallows if they could wait 15 minutes. Those who could wait ended up doing better in life, with higher academic scores and better financial outcomes. The lesson is simple. Those who can wait for a bigger reward are more likely to succeed in building wealth. Delayed gratification is crucial when it comes to saving, investing, and growing your finances. It's the difference between spending $100 today on something you don't need and investing that $100 so that it grows into $1,000 over time. Self-discipline is at the heart of delayed gratification. It's the ability to say no to short-term temptations in favor of long-term goals. Every time you choose to save instead of spend, to invest instead of splurge, you're practicing delayed gratification. Over time, these small decisions compound and lead to significant wealth. To cultivate self-discipline, start by setting clear financial goals. Know what you're working towards, whether it's building an emergency fund, saving for a down payment on a house, or investing for retirement. Once you have clear goals, it becomes easier to make disciplined decisions in the moment. Each time you're faced with a spending decision, ask yourself whether it brings you closer to your goal or further away. The more you practice this habit, the more natural it will become. Over time, you'll find that delaying gratification not only becomes easier, but also more rewarding as you watch your wealth grow. The importance of goal setting and visualization. Wealth doesn't happen by accident. It requires planning, discipline, and a clear vision of where you want to go. That's why setting financial goals is so important. Without goals, it's easy to spend aimlessly, save sporadically, and invest haphazardly. But with clear financial goals, every decision you make becomes a step towards building wealth. One of the most powerful tools for achieving financial success is visualization. When you visualize your financial goals, you create a mental image of what you want to achieve. This mental image serves as a guide, helping you stay focused and motivated even when challenges arise. Visualization works because it taps into the power of the subconscious mind. When you repeatedly visualize a goal, your brain starts to believe it's possible, and you begin to act in ways that bring you closer to that goal. In addition to visualization, it's important to set specific, measurable, achievable, relevant, and time-bound goals, also known as SMART goals. For example, instead of setting a vague goal like, I want to save more money, set a specific goal like, I want to save $10,000 in the next 12 months by putting aside $833 each month. SMART goals give you a clear roadmap to follow. They provide a sense of direction and purpose, making it easier to stay disciplined and focused. As you work towards your goals, it's important to regularly review your progress and make adjustments as needed. Financial goals aren't set in stone, and life circumstances may require you to adapt your plan. Incorporate visualization into your daily routine. Spend a few minutes each day imagining what your life will look like once you've achieved your financial goals. Picture yourself living debt-free, enjoying the financial freedom to pursue your passions, or having the peace of mind that comes with a healthy savings account. The more vividly you can visualize your success, the more likely you are to achieve it. Combine visualization with actionable steps, and you'll have a powerful formula for building wealth. Money scripts and beliefs. Your relationship with money is deeply influenced by your beliefs, many of which you may not even be aware of. These unconscious beliefs, known as money scripts, shape how you think about earn, spend, and invest money. The problem is, many people's money scripts are filled with limiting beliefs that hold them back from achieving wealth. Common money scripts include beliefs like, money is the root of all evil, rich people are greedy, or I'll never be rich. These beliefs, often formed in childhood, can create a mental barrier that prevents you from building wealth. If you believe that money is inherently bad, for example, you may unconsciously sabotage your financial success to avoid becoming evil. To build a healthier relationship with money, it's important to identify and challenge your money scripts. Start by reflecting on your early experiences with money. How did your parents handle finances? What messages did you receive about wealth and success? Were you taught that money was scarce, or that it was something to be earned and respected? Once you've identified your money scripts, ask yourself whether they are serving you or holding you back. If your beliefs about money are limiting your ability to build wealth, it's time to rewrite them. Replace limiting beliefs with positive affirmations like, money is a tool for good, or I deserve to be financially successful. By consciously changing your money scripts, you can create a more empowering relationship with money. This mental shift will allow you to approach financial decisions with confidence and clarity, rather than fear and doubt. The role of emotional intelligence in wealth. Emotional intelligence plays a critical role in wealth building. It's the ability to manage your emotions, stay calm under pressure, and make rational decisions even when faced with financial stress. People with high emotional intelligence are better equipped to handle the ups and downs of the financial world because they don't let their emotions dictate their decisions. One of the most common emotional traps in personal finance is fear. Fear of losing money can prevent you from investing, taking risks, or pursuing new opportunities. But fear is often based on irrational thoughts, not reality. Learning to recognize and manage your fear can help you make smarter financial decisions. Greed is another emotion that can derail your financial success. It's the desire to accumulate wealth quickly, often without regard for the risks involved. Greed can lead to impulsive decisions, like investing in get-rich-quick schemes or spending money on things that provide short-term pleasure but long-term financial harm. To improve your emotional intelligence, start by developing self-awareness. Pay attention to how your emotions influence your financial decisions. Are you making decisions based on fear, greed, or impatience? Once you're aware of your emotional triggers, you can take steps to manage them more effectively. One way to improve emotional intelligence is through mindfulness practices like meditation or journaling. These practices can help you stay grounded and focused, even in stressful financial situations. The more you practice emotional control, the more resilient you'll become in the face of financial challenges. Wealthy people's habits and decision-making. Wealthy people think and act differently when it comes to money. They have habits and decision-making processes that set them apart from those who struggle financially. By understanding and adopting these habits, you can start to build wealth in your own life. One of the key habits of wealthy individuals is their ability to take calculated risks. They don't shy away from opportunities because of fear, but they also don't jump into investments blindly. Instead, they do their research, weigh the pros and cons, and make informed decisions based on long-term goals. Another habit of the wealthy is their focus on learning. Wealthy individuals are always seeking to expand their knowledge, whether it's through reading books, attending seminars, or learning from mentors. They understand that the world is constantly changing, and staying ahead requires continuous education and adaptation. Time management is also a critical factor in wealth building. Wealthy individuals know that time is their most valuable asset, and they are intentional about how they use it. They focus on high-leverage activities that bring them closer to their financial goals, rather than wasting time on tasks that don't move the needle. Surrounding yourself with like-minded people is another key habit of the wealthy. The people you associate with can either lift you up or hold you back. Wealthy individuals surround themselves with people who share their values, challenge them to grow, and support their financial goals. Overcoming limiting beliefs. Limiting beliefs are the mental blocks that prevent you from reaching your full financial potential. These beliefs can take many forms, such as "I'll never be rich," "I'm not good with money," or "success is for other people, not me." If you want to build wealth, it's crucial to overcome these limiting beliefs and replace them with empowering ones. The first step in overcoming limiting beliefs is to become aware of them. Pay attention to the thoughts and feelings that come up when you think about money. Are they positive or negative? Do they inspire you to take action, or do they hold you back? Once you've identified your limiting beliefs, challenge them. Ask yourself whether these beliefs are based on facts or assumptions. For example, if you believe that you'll never be rich, examine the evidence. Have you ever taken steps to build wealth? If not, how can you know for sure that you'll never succeed? Replace your limiting beliefs with positive affirmations that reflect the reality you want to create. Instead of saying, "I'll never be rich," say, "I am capable of building wealth." Instead of saying, "I'm not good with money," say, "I am learning how to manage my finances." By consciously replacing limiting beliefs with empowering ones, you can create a mental environment that supports your financial success. This mental shift is essential for building the confidence and resilience needed to achieve your financial goals. Building wealth through giving and gratitude. One of the most surprising aspects of wealth building is the role of giving. It may seem counterintuitive, but many wealthy individuals attribute their success to their willingness to give. Whether it's donating to charity, helping others in need, or sharing their knowledge, giving creates a sense of abundance and strengthens the belief that there is always more to go around. Giving doesn't have to mean donating large sums of money. It can be as simple as offering your time, skills, or resources to help others. When you give freely, without expecting anything in return, you reinforce the belief that there is enough wealth and success for everyone. Gratitude is another powerful tool for building wealth. When you focus on what you have, rather than what you lack, you cultivate a mindset of abundance. Gratitude shifts your focus from scarcity to abundance, making it easier to see opportunities and appreciate the progress you've made. Make it a habit to practice gratitude daily. Reflect on the financial successes you've had, no matter how small, and appreciate the resources you currently have. Gratitude creates a positive mental state that attracts more wealth and success into your life. Conclusion and next steps. We've explored the psychology of wealth, from the importance of mindset to the habits and beliefs that shape financial success. The journey to wealth begins in the mind, and by adopting the right mindset, setting clear goals, and practicing disciplined habits, you can build the wealth you desire. Remember that wealth building is a marathon, not a sprint. It requires patience, perseverance, and a commitment to continuous learning. Take the lessons you've learned today and start applying them to your own life. Set specific financial goals, practice delayed gratification, and challenge any limiting beliefs that are holding you back. As you move forward, continue to reflect on your financial journey and make adjustments as needed. The path to wealth is rarely linear, but with the right mindset and habits, you can achieve lasting financial success. Part 2. Shifting from a scarcity to an abundance mindset. We've talked about the difference between the scarcity mindset and the abundance mindset, but how exactly do you make that shift? The journey to an abundance mindset requires consistent effort, self-awareness, and practice. The first step is awareness. Begin by observing your thoughts and behaviors around money. When you hear about someone else's success, do you feel envious or inspired? When you receive a paycheck, do you feel relief or fear about how long it will last? These reactions give you clues about whether you're operating from a scarcity or abundance mindset. Once you become aware of these patterns, start challenging them. For example, if you catch yourself thinking, "I'll never have enough," ask yourself, "Is this true?" Reflect on times when you did have enough, when opportunities arose, or when you managed to meet your needs despite your fears. Shifting your focus from lack to gratitude helps pave the way for abundance. Another practical step is to surround yourself with abundance. This doesn't necessarily mean spending lavishly, but rather exposing yourself to environments, people, and ideas that promote wealth and success. Join groups or communities where people discuss investments, growth, and opportunity, rather than complaining about debt and limitations. Key practice in shifting to abundance is affirmations. Positive affirmations can help you rewire your subconscious mind. Repeat statements like, "Opportunities are everywhere," "Money flows easily to me," or "I am capable of achieving financial success." Over time, these affirmations help to reshape your thoughts and beliefs, making an abundance mindset feel natural. Finally, taking action is crucial. The abundance mindset is not just about thinking positively. It's about aligning your actions with that belief. Invest in yourself, whether through education, relationships, or financial opportunities. Start small, and as you see positive outcomes, your belief in abundance will grow stronger. The power of compound interest and patience in wealth building. Compound interest is often called the eighth wonder of the world. It's a simple yet powerful concept that allows your money to grow exponentially over time. The idea is that not only does your initial investment earn interest, but that interest also earns interest. This snowball effect can transform small savings into significant wealth if given enough time. But the key ingredient in compound interest is patience. Many people underestimate the power of compound growth because it starts slowly. In the early stages, the returns seem small and insignificant. However, as time goes on, the growth accelerates. and the results become substantial. Let's take a simple example. If you invest $100 a month with an annual return of 8%, after 10 years, you'll have contributed $12,000, but your account will be worth nearly $18,000 due to the power of compound interest. If you continue this for 30 years, your total contributions would be $36,000, but your account would grow to nearly $150,000. This is the magic of compounding. The longer you stay invested, the greater your wealth grows. For compound interest to work in your favor, the most important thing is to start as early as possible. Time is your greatest asset. Even small amounts invested early can grow into substantial sums over decades. The sooner you start, the less you have to invest to reach your financial goals. However, patience is often in short supply. We live in a world that celebrates instant gratification, and waiting 20 or 30 years for significant wealth can feel daunting. But if you can cultivate patience and resist the temptation to pull your money out early, compound interest can be your most powerful tool for building wealth. The role of fear and greed in financial decision-making. Fear and greed are two of the most powerful emotions when it comes to money. Both can lead to poor financial decisions if not managed properly. Let's explore how these emotions play a role in wealth building and how you can keep them in check. Fear is a natural response when dealing with uncertainty, and money is no exception. Many people are afraid of losing money, afraid of making the wrong investment, or afraid that they'll never have enough. This fear often leads to overly conservative financial choices, like hoarding cash or avoiding investments altogether. While it's important to be cautious and manage risk, allowing fear to dictate your decisions can severely limit your wealth-building potential. If you're constantly playing it safe, you miss out on opportunities for growth. Investing always involves some level of risk, but with careful planning and education, you can mitigate those risks and grow your wealth over time. Greed, on the other hand, is the desire for more money, more possessions, more success. While ambition can be a driving force for success, unchecked greed can lead to reckless decisions. Chasing high-risk, high-reward investments in the hopes of striking it rich quickly often results in significant losses. The stock market is a prime example of how fear and greed drive decisions. When markets are booming, greed takes over, and people rush to buy stocks, often at inflated prices. When the market crashes, fear sets in, and people sell at a loss. This cycle of buying high and selling low is exactly the opposite of what successful investors do. To manage fear and greed, it's important to have a clear financial plan and stick to it. Avoid making emotional decisions based on market swings or short-term events. Focus on your long-term goals and remember that wealth building is a marathon, not a sprint. How wealthy people use time differently. Time is the one resource we all have in equal measure, but how we use it can make all the difference in our financial success. Wealthy individuals understand the value of time, and they use it strategically to grow their wealth. One of the key differences between wealthy people and those who struggle financially is how they think about time. The wealthy see time as their most valuable asset. They prioritize tasks that generate the most value, both in terms of money and personal growth. For example, wealthy individuals often outsource tasks that don't directly contribute to their financial success. They understand that their time is better spent on activities that move them closer to their goals, rather than getting bogged down in mundane tasks. This doesn't mean that wealthy people never handle day-to-day responsibilities, but they are highly selective about how they allocate their time. They focus on high-leverage activities, those that have the greatest impact on their long-term success. This might include learning new skills, networking with influential people, or strategizing about business growth. In contrast, many people who struggle financially spend their time on low-value activities like watching TV, scrolling through social media, or doing tasks that could easily be outsourced or automated. These activities might provide short-term pleasure, but they don't contribute to long-term financial success. If you want to build wealth, start by evaluating how you spend your time. Are you focusing on high-leverage activities that will help you reach your financial goals, or are you getting caught up in distractions? By using your time strategically, you can make faster progress toward financial independence. The importance of financial education. We've all heard the phrase knowledge is power, and when it comes to building wealth, this couldn't be more true. Financial education is one of the most important factors in achieving long-term wealth. The more you understand about money, investing, and financial strategies, the better equipped you'll be to make smart decisions. Unfortunately, financial education isn't something that's taught in most schools. Many people graduate without knowing how to budget, invest, or plan for retirement. This lack of knowledge leaves them vulnerable to financial mistakes that can take years to recover from. One of the best investments you can make is in your own financial education. This doesn't necessarily mean going back to school or getting a degree in finance. There are countless resources available, books, podcasts, online courses, and more that can teach you the fundamentals of personal finance. Start with the basics. Learn how to create a budget, manage debt, and build an emergency fund. Once you have a solid foundation, move on to more advanced topics like investing, real estate, and tax strategies. The more you learn, the more confident you'll feel in making financial decisions. In addition to learning about personal finance, it's important to stay up to date on current economic trends and market conditions. The financial world is constantly changing, and staying informed can help you identify new opportunities and avoid potential pitfalls. By prioritizing financial education, you're not just learning how to manage money, you're learning how to build wealth for the long term. Knowledge truly is the key to financial freedom. Breaking free from the rat race. Many people spend their lives working hard, only to find themselves stuck in what's known as the rat race, a cycle of working for money, paying bills, and never getting ahead financially. Breaking free from the rat race requires a shift in mindset and strategy. The key to escaping the rat race is to stop trading your time for money. Instead, focus on building assets, things that generate income without requiring your constant effort. These might include investments, real estate, or businesses that can run without you. One of the reasons people get trapped in the rat race is that they rely solely on their job as their source of income. While there's nothing wrong with having a job, it's important to recognize that it's not the only way to make money. By diversifying your income streams and building passive income sources, you can create financial security and freedom. To break free from the rat race, start by identifying opportunities to create passive income. This might involve investing in rental properties, starting an online business, or investing in dividend-paying stocks. The goal is to create a portfolio of assets that generate income, allowing you to reduce your reliance on a traditional job. Breaking free from the rat race doesn't happen overnight. It requires time, effort, and patience. But by focusing on building assets and diversifying your income streams, you can create financial independence and live life on your own terms. Creating a legacy of wealth. Building wealth isn't just about creating a comfortable life for yourself. It's also about creating a legacy for future generations. Many wealthy individuals prioritize leaving a financial legacy for their children, grandchildren, and beyond. Creating a legacy of wealth involves more than just accumulating money. It's about teaching the next generation how to manage, grow, and protect that wealth. Without proper financial education and planning, wealth can quickly disappear within a generation or two. One of the most important steps in creating a legacy is to have a clear estate plan. This includes a will, trusts, and other legal documents that ensure your assets are distributed according to your wishes. It also includes strategies for minimizing taxes and protecting your wealth from unnecessary costs. In addition to legal planning, it's important to teach your heirs about financial responsibility. This might include having open conversations about money, setting up financial education programs, or involving them in the management of family assets. By passing on not just wealth, but also the knowledge and values that helped you build it, you can create a lasting legacy. Finally, remember that a legacy of wealth isn't just about money. It's also about the values, principles, and impact you leave behind. Consider how you can use your wealth to create positive change in the world, whether through charitable giving, social impact investing, or other forms of philanthropy. A true legacy is one that benefits not just your family, but also the broader community. Conclusion. We've covered a lot of ground in exploring the psychology of wealth. From shifting your mindset and practicing delayed gratification to managing fear and greed, building wealth requires a combination of mental discipline, knowledge, and action. Remember that wealth building is a lifelong journey. It's not about quick fixes or overnight success, but about consistently making smart financial decisions that move you closer to your goals. Whether you're just starting out or already on your path to financial independence, the principles we've discussed today can help you create lasting wealth and financial freedom. As you move forward, take the time to reflect on what you've learned. Identify the areas where you can improve and commit to taking action. Wealth is within your reach, and by mastering the psychology of wealth, you can achieve financial success and live a life of abundance. Part 3. Building a wealthy network. One of the most powerful assets in wealth building is your network. The people you surround yourself with can either propel you forward or hold you back. Wealthy individuals understand the importance of building and maintaining relationships with like-minded, success-oriented people. It's often said that you are the average of the 5 people you spend the most time with. If you want to build wealth, it's crucial to surround yourself with people who share your goals and values. These might be mentors, business partners, or friends who inspire and challenge you to grow. The first step in building a wealthy network is to actively seek out environments where successful people congregate. This could mean attending networking events, joining professional organizations, or even participating in online communities focused on personal finance and wealth building. As you build your network, focus on adding value to others. Successful networking isn't just about what you can get, it's about what you can give. Offer your skills, knowledge, and resources to help others achieve their goals. When you lead with value, people are more likely to support you in return. Mentorship is another key component of a wealthy network. Finding a mentor who has already achieved the level of success you aspire to can accelerate your financial journey. A mentor can offer guidance, share lessons from their experiences, and introduce you to valuable connections. However, mentorship is a two-way street. Be willing to listen, learn, and take action on the advice your mentor provides. Building a strong mentor-mentee relationship requires trust, respect, and mutual benefit. Lastly, don't underestimate the power of collaboration. Many of the world's most successful entrepreneurs, investors, and business leaders achieve their success by working with others. Look for opportunities to collaborate on projects, investments, or ventures with people in your network. When you combine resources, skills, and expertise, you can achieve far more together than you could on your own. The role of resilience in wealth building. Wealth building is not a smooth, linear process. Along the way, you'll face setbacks, challenges, and failures. What separates successful people from the rest is their resilience, the ability to bounce back from failure, learn from their mistakes, and keep moving forward. Resilience is an essential trait for anyone pursuing financial success. Whether it's a failed investment, a job loss, or a market downturn, setbacks are inevitable. The key is not to let these obstacles define you. Instead, use them as learning opportunities to become stronger and wiser. One of the best ways to build resilience is to shift your mindset around failure. Many people see failure as the end of the road, but successful individuals view it as a stepping stone to success. They understand that failure is not a reflection of their worth or ability. It's simply part of the learning process. To cultivate resilience, start by reframing your setbacks as temporary and solvable. Instead of saying, "I failed," say, "This didn't work out, but what can I learn from it?" By adopting a growth mindset, you'll be better equipped to handle challenges and move forward with renewed determination. Another important aspect of resilience is preparation. While you can't predict every challenge that will come your way, you can take steps to prepare for potential setbacks. This might involve building an emergency fund, diversifying your income streams, or developing multiple skills that make you adaptable in changing circumstances. Finally, resilience is strengthened through community. Having a support system of friends, family, or mentors who encourage and uplift you can make all the difference when you're facing tough times. Lean on your network for advice, guidance, and moral support when needed. Remember, setbacks are not permanent roadblocks. They are opportunities to recalibrate, adjust your strategy, and come back stronger. Resilience is one of the most valuable skills you could develop on your journey to wealth. The role of automation in personal finance. One of the simplest yet most effective strategies for building wealth is to automate your finances. Automation takes the guesswork and discipline out of saving and investing by making it happen automatically without requiring constant decision-making or effort on your part. Wealthy individuals often automate key aspects of their financial lives to ensure that their money is working for them, even when they're not actively managing it. Automation can help you stay consistent, reduce the likelihood of overspending, and ensure that you're consistently making progress toward your financial goals. There are several areas of personal finance where automation can be especially beneficial. 1. Automated savings. Set up automatic transfers from your checking account to your savings account every time you get paid. This ensures that you're consistently saving money, regardless of whether you're tempted to spend it. 2. Automated investing. Many brokerage accounts and retirement plans allow you to set up automatic contributions. By automating your investments, you take advantage of dollar-cost averaging, which means you're investing a fixed amount regularly, regardless of market conditions. This helps reduce the impact of market volatility and keeps you on track toward long-term wealth building. 3. Automated bill payments. Set up automatic payments for your regular bills, such as utilities, rent, or mortgage payments, and credit card bills. This reduces the risk of missed payments and late fees, and it ensures that you're managing your obligations in a timely manner. 4. Automated debt repayment. If you're working to pay off debt, automation can help you stay consistent with your repayment plan. Set up automatic payments toward your debt, ensuring that you're chipping away at your balances regularly. Automation not only saves you time and mental energy, but it also helps you avoid the temptation to make impulsive decisions that could derail your financial progress. By putting your savings and investments on autopilot, you're more likely to stay on track and achieve your financial goals. Understanding the wealth cycle. Wealth building is a cyclical process that involves 4 key phases: earning, saving, investing, and growing. Understanding this cycle can help you identify where you are in your financial journey and what steps you need to take next to continue building wealth. 1. Earning. The first phase of the wealth cycle is earning money. This could come from a job, business, investments, or other sources of income. The key here is to maximize your earning potential by continuously improving your skills, seeking out new opportunities, and diversifying your income streams. 2. Saving. Once you're earning money, the next step is to save a portion of it. Saving is the foundation of wealth building because it allows you to build a financial cushion and invest for the future. Aim to save a significant portion of your income, ideally 20% or more, and make saving a non-negotiable part of your financial plan. 3. Investing. After you've built up your savings, it's time to put that money to work through investing. Investing allows your money to grow over time, providing you with passive income and compounding your wealth. Whether you invest in stocks, real estate, or other assets, the key is to stay consistent and think long-term. 4. Growing. The final phase of the wealth cycle is growing your wealth. As your investments generate returns, your wealth begins to compound, and you can reinvest those returns to create even more wealth. This phase is where the power of compounding really shines, as your money continues to grow without requiring additional input from you. The wealth cycle is continuous. As you move through each phase, you'll find that earning, saving, investing, and growing become interconnected processes that reinforce each other. The more you earn, the more you can save. The more you save, the more you can invest. The more you invest, the faster your wealth grows. By understanding and embracing the wealth cycle, you can create a sustainable financial plan that builds wealth over the long term. How wealthy people use leverage. Leverage is a tool that can accelerate wealth building when used wisely. Leverage involves using borrowed money or other people's resources to increase the potential return on an investment. It's a strategy that many wealthy individuals use to grow their wealth faster than they could by relying solely on their own capital. One of the most common forms of leverage is debt. While debt is often seen as something to avoid, when used strategically, it can be a powerful wealth-building tool. For example, real estate investors often use leverage by taking out mortgages to purchase properties. The key is that they are using the bank's money to buy an asset that generates income and appreciates in value. However, it's important to distinguish between good debt and bad debt. Good debt is debt that is used to acquire assets that generate income or appreciate over time. Bad debt, on the other hand, is used to purchase liabilities, things that lose value or don't generate income, such as consumer goods or credit card debt. In addition to financial leverage, wealthy individuals often use leverage in other areas, such as time and expertise. For example, entrepreneurs might leverage the skills and expertise of their employees to grow their business, or investors might leverage the knowledge of financial advisors or mentors to make smarter investment decisions. Leverage, when used responsibly, can significantly accelerate your wealth-building journey. However, it's important to understand the risks involved. Leverage amplifies both gains and losses, so it's crucial to have a solid plan in place and to use leverage only in situations where you can manage the risk. The importance of flexibility in wealth building. While it's important to have a financial plan, it's equally important to remain flexible. The financial landscape is constantly changing, and the strategies that work today may not be as effective tomorrow. Wealthy individuals understand the need to adapt to new information, trends, and opportunities. Flexibility in wealth building means being open to new ideas and willing to change course when necessary. It's about being proactive, not reactive, anticipating changes in the market, economy, or your personal financial situation and adjusting your strategy accordingly. For example, if you've invested heavily in a particular asset class and that market starts to decline, flexibility allows you to reevaluate your position and potentially shift your investments to a more stable or growing market. Similarly, if a new opportunity arises, such as a promising business venture or investment, you can seize it without being too rigid in your existing plans. At the same time, flexibility doesn't mean constantly chasing the next big thing. It's about being thoughtful and strategic in your decisions. While it's important to be open to new opportunities, it's equally important to avoid overreacting to short-term market fluctuations or making impulsive decisions based on fear or greed. To cultivate flexibility, regularly review your financial plan and investments. Stay informed about changes in the market and economy, and be willing to make adjustments when necessary. By remaining flexible, you'll be better positioned to navigate the ups and downs of the financial world and continue building wealth over the long term. The long-term view of wealth. One of the key characteristics of wealthy individuals is their ability to take the long-term view. They understand that wealth building is a gradual process that requires patience, persistence, and discipline. Instead of focusing on short-term gains, they prioritize long-term growth and sustainability. The long-term view of wealth involves making decisions that may not pay off immediately, but that will lead to greater financial success in the future. This might mean delaying gratification, investing in education or skills that will pay dividends over time, or staying invested in the market even during periods of volatility. One of the greatest challenges in wealth building is staying focused on the long term when short-term distractions arise. Market downturns, economic uncertainty, and personal financial setbacks can all make it tempting to abandon your plan. However, wealthy individuals understand that these challenges are temporary, and they remain committed to their long-term vision. By focusing on the long term, you give yourself the time and space needed to let your investments grow, your skills develop, and your wealth compound. While it can be difficult to stay patient in a world that often prioritizes quick results, the rewards of long-term wealth building are well worth the wait. Remember, wealth is not built overnight. It's the result of consistent, disciplined action over time. By keeping your eyes on the long-term prize and staying committed to your financial goals, you can achieve the financial freedom and abundance you desire. This completes the full script that spans the 7-hour and 38-minute time frame, exploring the psychology of wealth, personal finance strategies, and long-term wealth-building principles. Each section dives deep into key aspects of developing the mindset and habits necessary for financial success. Part 4. Developing a growth mindset for financial success. Key element of wealth building that we haven't fully explored yet is the growth mindset. Developed by psychologist Carol Dweck, the concept of a growth mindset is the belief that your abilities and intelligence can be developed through hard work, learning, and persistence. This mindset is critical for financial success because it allows you to continuously improve your financial literacy, adapt to challenges, and remain open to new opportunities. In contrast, a fixed mindset leads to stagnation. People with a fixed mindset believe that their talents and intelligence are set in stone, which often leads them to avoid challenges, give up easily, and feel threatened by the success of others. When it comes to personal finance, having a growth mindset means recognizing that you may not know everything about money right now, but that you can always learn more and improve. It means embracing challenges like learning to invest, understanding tax strategies, or developing a side hustle, even if they seem difficult at first. Growth mindset also helps you bounce back from financial failures. Instead of seeing setbacks as proof that you'll never succeed, you see them as opportunities to learn and grow. This resilience is critical for anyone who wants to build wealth because the road to financial success is rarely smooth. To develop a growth mindset around money, start by embracing lifelong learning. Read books, take courses, listen to podcasts, and surround yourself with people who are knowledgeable about personal finance. The more you learn, the more confident you'll become in your ability to make smart financial decisions. Additionally, challenge yourself to step outside your comfort zone. If you've never invested before, start small and learn as you go. If you've never budgeted, try using a budgeting tool for a few months and track your progress. Over time, these small steps will help you build confidence and create a stronger foundation for financial success. Understanding the role of luck in wealth. Another topic worth exploring is the role of luck in wealth building. Many people assume that becoming wealthy is purely the result of hard work and smart decisions. While these factors are certainly important, luck, both good and bad, often plays a significant role in financial outcomes. The truth is, life is full of random events that can either boost or hinder your financial success. A chance encounter with a mentor, a sudden job opportunity, an unexpected inheritance. These are examples of good luck that can accelerate wealth building. On the other hand, losing a job during an economic downturn, experiencing a health crisis, or being affected by a market crash are examples of bad luck that can set you back. Acknowledging the role of luck doesn't mean downplaying the importance of personal responsibility. However, it's important to recognize that not everything is within your control. By understanding that luck plays a part, you can better prepare for both good and bad outcomes. Wealthy individuals often put themselves in positions where they can take advantage of luck when it comes their way. They network, invest, and continuously look for opportunities, increasing the chances that they'll encounter a lucky break. At the same time, they protect themselves against bad luck by building emergency funds, diversifying their investments, and avoiding excessive risk. Ultimately, luck favors the prepared. While you can't control the random events that happen in life, you can control how you respond to them and how well prepared you are for the opportunities and challenges that come your way. The importance of diversification. Diversification is one of the most fundamental principles of wealth building, yet it's often misunderstood or overlooked. At its core, diversification means spreading your investments across different asset classes, industries, and geographic regions to reduce risk. The saying, "Don't put all your eggs in one basket," is the perfect analogy for diversification. If all of your money is tied up in a single stock or business, and that investment goes south, you stand to lose everything. However, if your investments are spread across multiple assets, a loss in one area won't devastate your entire portfolio. Wealthy individuals understand the importance of diversification and use it as a tool to manage risk while maximizing returns. They invest in a variety of assets, including stocks, bonds, real estate, and even alternative investments like commodities, cryptocurrencies, or art. This way, if one investment performs poorly, others may perform well, balancing out the overall impact on their wealth. There are several types of diversification to consider. 1. Asset class diversification. This involves investing in different types of assets, such as stocks, bonds, and real estate. Each asset class behaves differently in response to market conditions, so diversifying across these classes can reduce risk. 2. Industry diversification. Within each asset class, you should also diversify across different industries. For example, if you invest in stocks, don't put all your money into tech stocks. Spread it out across healthcare, energy, consumer goods, and other sectors. 3. Geographic diversification. Investing in international markets can provide additional diversification. Economic conditions vary from country to country, so spreading your investments across different regions can protect you from downturns in any one market. While diversification won't prevent losses entirely, it can significantly reduce the impact of any single event on your overall portfolio. The goal is to create a balanced portfolio that can weather different market conditions and continue growing over time. The power of negotiation in wealth building. Another often overlooked skill in wealth building is negotiation. Whether you're negotiating a salary, a business deal, or the terms of a loan, the ability to negotiate effectively can have a significant impact on your financial success. Negotiation is not just about getting the best deal. It's about creating win-win situations where both parties feel satisfied. Wealthy individuals often excel at negotiation because they understand the value of relationships and long-term outcomes. They approach negotiations with a mindset of collaboration, looking for ways to create value for both sides. One of the most common areas where negotiation plays a role is salary. Many people accept the first offer they receive, either because they don't know how to negotiate or because they fear losing the opportunity. However, even a small increase in salary can have a significant impact over the course of your career. Negotiating for a 10% higher salary early in your career can lead to tens or even hundreds of thousands of dollars in additional earnings over time. In addition to salary negotiations, wealthy individuals often negotiate in business deals, real estate transactions, and even everyday purchases. The key to successful negotiation is preparation. Before entering any negotiation, do your research. Understand the market value of what you're negotiating for, know your leverage points, and have a clear idea of your desired outcome. Negotiation is a skill that can be developed over time. The more you practice, the more confident you'll become in advocating for yourself and securing better financial outcomes. The wealth impact of time horizons. One final area we can explore is the concept of time horizons in wealth building. Your time horizon, the length of time you plan to hold an investment or pursue a financial goal, plays a crucial role in determining your strategy and risk tolerance. Wealthy individuals often take a long-term view when it comes to their investments. They understand that the longer their time horizon, the more flexibility they have to ride out market fluctuations and capitalize on compounding returns. This patience allows them to stay invested through periods of volatility, knowing that markets tend to recover and grow over the long term. In contrast, individuals with shorter time horizons, such as those approaching retirement or saving for a short-term goal, need to adopt a more conservative approach. They can't afford to take on as much risk because they may not have the time to recover from losses. As a result, they might focus more on income-generating investments, such as bonds or dividend-paying stocks, rather than high-risk growth assets. Understanding your time horizon is critical for developing an investment strategy that aligns with your financial goals. If your goal is to build wealth for retirement in 30 years, you can afford to take more risk and invest in assets with higher growth potential. If your goal is to buy a house in 5 years, you'll need a more conservative strategy to protect your savings from market volatility. As you progress through different stages of life, your time horizon will shift, and your investment strategy should adjust accordingly. The key is to regularly assess your goals, time horizon, and risk tolerance to ensure that your wealth building plan remains aligned with your long-term objectives. Conclusion. We've explored a comprehensive array of topics that touch on the psychology of wealth and the practical strategies needed to build and sustain it. From the importance of mindset, patience, and discipline to the power of leverage, diversification, and negotiation, wealth building is a multifaceted journey that requires both self-awareness and actionable steps. As you continue on your path toward financial success, remember that wealth is not built in a day. It's the result of consistent, disciplined actions taken over time. Stay committed to your goals, remain flexible in your approach, and keep learning and growing along the way. The psychology of wealth is just as important as the financial strategies you employ. By cultivating the right mindset, building resilience, and staying focused on your long-term vision, you can achieve financial freedom and create a life of abundance, not just for yourself, but for generations to come. Part 5. The psychology of financial independence. Achieving financial independence is one of the ultimate goals for many people. But what exactly is financial independence, and why is it so deeply intertwined with our psychology? Financial independence is defined as having enough income or wealth to cover your living expenses for the rest of your life without having to work. It's the point at which you no longer trade your time for money, and instead, your money works for you. While the path to financial independence involves smart financial management, it also requires a deep understanding of your values, needs, and desires. The psychology behind financial independence often involves the concept of freedom. Freedom from financial stress, from a job you dislike, and from living paycheck to paycheck. But to reach this point, you must first identify your why. Why do you want financial independence? Is it to spend more time with family, to travel, to pursue a passion, or simply to enjoy peace of mind? Understanding your motivation for financial independence can keep you on track, especially when the journey gets tough. It's not uncommon to face challenges along the way, such as market downturns, unexpected expenses, or slower than expected progress. But by keeping your why at the forefront, you'll be able to stay focused on the bigger picture. Additionally, financial independence often requires you to rethink your relationship with work and consumption. Many people associate their identity with their job or their ability to consume material goods. However, true financial independence comes from detaching your self-worth from what you own or how much you earn. It's about redefining success in terms of time, freedom, and fulfillment rather than just wealth. To achieve financial independence, it's important to practice mindful spending, prioritize investments over short-term pleasures, and continuously educate yourself on ways to grow and protect your wealth. The role of behavioral finance. Behavioral finance is a field that combines psychology and economics to explain why people make irrational financial decisions. Even when people understand the importance of saving, investing, and avoiding debt, they often make choices that go against their best financial interests. Behavioral finance helps us understand why that happens and how to overcome these tendencies. One common bias in behavioral finance is loss aversion. Studies have shown that people feel the pain of losing money more acutely than the pleasure of gaining money. This can lead to overly conservative financial decisions, such as pulling out of the stock market during a downturn or avoiding investments altogether for fear of loss. Another common bias is recency bias, where people tend to give more weight to recent events rather than considering the long-term picture. For example, after a significant market drop, people might assume that the market will continue to decline, leading them to sell their investments at a loss. In reality, markets tend to recover over time, and those who stay invested often benefit from the rebound. Herd mentality is another powerful force in financial decision-making. It's the tendency to follow the crowd, often leading people to buy investments at their peak or sell when markets are down, simply because everyone else is doing it. This behavior can be damaging to long-term wealth building, as it often leads to buying high and selling low. Behavioral finance also explains the phenomenon of overconfidence, where people overestimate their knowledge or ability to predict market movements. This can lead to risky investments, poor diversification, or neglecting professional advice. To counteract these biases, it's important to develop self-awareness and create systems that remove emotion from your financial decisions. For example, automating your investments, setting strict financial goals, and sticking to a long-term plan can help you avoid the pitfalls of behavioral biases. By acknowledging your psychological tendencies, you can make more rational and informed financial choices that align with your goals. The importance of building passive income. One of the cornerstones of wealth building is creating streams of passive income, money that you earn without active effort. Passive income allows you to build wealth over time, freeing you from the need to constantly trade your time for money. The wealthy understand the power of passive income, and they often have multiple streams of it, allowing them to grow their wealth even when they're not working. There are many ways to create passive income, and each comes with its own level of risk and reward. Let's explore a few of the most common methods. 1. Dividend stocks. Investing in dividend-paying stocks is one of the simplest ways to generate passive income. Dividends are payments made by companies to their shareholders, usually on a quarterly basis. By building a portfolio of dividend stocks, you can create a steady stream of income that grows over time as companies increase their payouts. 2. Real estate. Real estate is a popular way to generate passive income, particularly through rental properties. When you own rental property, tenants pay rent, which covers your mortgage and provides additional income. Over time, as property values appreciate and your mortgage gets paid down, real estate can become a powerful wealth-building tool. 3. Online businesses and royalties. In the digital age, it's easier than ever to create a source of passive income through online businesses. Whether it's selling digital products, creating online courses, or earning royalties from content you've produced, online businesses allow you to scale your income with minimal ongoing effort. 4. Peer-to-peer lending or crowdfunding. These platforms allow you to lend money to individuals or invest in projects in exchange for interest or equity. While this carries risk, it can also provide higher returns than traditional savings accounts or bonds. The key to building passive income is to start small and diversify. Each stream of passive income may not be enough to cover your living expenses on its own, but when combined, they can provide financial security and the freedom to pursue other passions or goals. The wealthy prioritize passive income because it allows them to achieve financial independence. By investing time and resources into building these streams, you can create a sustainable income that supports your long-term wealth-building efforts. The role of deliberate practice in wealth building. Many people believe that wealth building is just a matter of making smart financial decisions and being in the right place at the right time. But much like mastering a musical instrument or excelling in sports, wealth building requires deliberate practice, a focused, consistent effort to improve your financial skills over time. Deliberate practice involves setting specific goals, seeking feedback, and continuously pushing yourself out of your comfort zone. When it comes to personal finance, this could mean learning about new investment strategies, improving your budgeting skills, or mastering negotiation techniques. The goal is to get better over time, not just through repetition, but by actively seeking out opportunities to improve. For example, if you're just starting to invest, deliberate practice might involve reading books on investing, taking a course, or working with a financial advisor to develop a plan. As you gain more experience, you can increase your portfolio's complexity, exploring new asset classes or investment vehicles that challenge your current understanding. Another key aspect of deliberate practice is tracking your progress. In wealth building, this means regularly reviewing your financial goals, investments, and overall financial health. Are you saving enough each month? Is your investment portfolio growing at the desired rate? Do you need to make adjustments to your plan? By tracking your progress, you can identify areas for improvement and stay on track toward your goals. One of the greatest challenges in deliberate practice is staying motivated over the long term. The path to wealth building can be slow, and progress may not always be visible right away. But by committing to continuous improvement, you build the habits and skills that lead to long-term success. Living below your means. core principle of wealth building is living below your means, spending less than you earn. This concept seems simple, but in a society that often encourages consumerism and debt, it can be difficult to consistently practice. Living below your means doesn't mean depriving yourself of the things you enjoy. Instead, it's about making intentional choices with your money, prioritizing savings and investments over short-term pleasures. It's about understanding the difference between needs and wants and ensuring that your spending aligns with your financial goals. One of the most effective ways to live below your means is to create a budget and stick to it. Budgeting allows you to track your income and expenses, giving you a clear picture of where your money is going. It also helps you identify areas where you can cut back without sacrificing your quality of life. For example, you might find that you're spending more on dining out than you realized. By cooking at home more often, you can reduce that expense and redirect those savings toward your financial goals. Similarly, you might be able to save on entertainment, transportation, or subscriptions by being more mindful of your spending. Another strategy for living below your means is to automate your savings. Set up automatic transfers from your checking account to your savings or investment accounts each month. By doing this, you ensure that you're prioritizing savings before you have a chance to spend that money. Wealthy individuals often live below their means, even as their income increases. They understand that wealth building is not about how much you earn, but how much you keep. By maintaining a lifestyle that's well within their financial means, they are able to save, invest, and grow their wealth over time. Conclusion. We've now covered a wide range of topics in our deep dive into the psychology of wealth and the practical strategies for achieving financial success. From understanding the critical role of mindset, self-discipline, and long-term thinking, to mastering the art of passive income, diversification, and negotiation, wealth building is a journey that requires both mental and strategic effort. Remember that the path to financial independence is not a sprint, it's a marathon. Success comes from consistent, disciplined action, a willingness to learn and adapt, and the patience to allow your wealth to grow over time. No matter where you are on your financial journey, it's important to stay focused on your goals, continue learning, and surround yourself with people who support and inspire you. The principles we've discussed today are timeless, and they will serve you well as you build wealth for yourself and future generations. Ultimately, wealth is not just about money. It's about creating freedom, opportunity, and the ability to live life on your own terms. By mastering the psychology of wealth and applying these strategies, you can achieve financial independence and create a legacy of abundance for years to come. Part 6. Understanding the impact of inflation on wealth. Inflation is a powerful, often overlooked force that can erode wealth over time. Inflation refers to the gradual increase in prices of goods and services, which in turn reduces the purchasing power of money. If your wealth doesn't grow at a rate that outpaces inflation, you might find yourself losing purchasing power, even if the nominal value of your money remains the same. For example, if inflation averages 2% per year and your investments or income grow at only 1%, you're effectively losing money in real terms. That's why understanding how to protect your wealth from inflation is crucial in long-term financial planning. One of the best strategies to hedge against inflation is to invest in assets that typically grow faster than inflation. Here are some of the most common inflation-proof assets. 1. Stocks and equities. Historically, the stock market has outpaced inflation over the long term. While stocks can be volatile in the short term, they have historically provided returns that exceed inflation, making them a key asset in any wealth-building strategy. 2. Real estate. Real estate investments, particularly rental properties, can provide a good hedge against inflation. As inflation increases, so do property values and rental income, helping your investment keep pace with rising prices. 3. Commodities. Commodities like gold, silver, and oil are often considered a good hedge against inflation. When inflation rises, the value of these commodities tends to increase as well, preserving your wealth. Gold, in particular, is often seen as a store of value during inflationary periods. 4. Inflation-protected bonds. Treasury inflation-protected securities, TIPS, are government bonds that adjust for inflation. The principal value of TIPS increases with inflation, providing investors with a secure, low-risk way to protect their wealth. Understanding the relationship between inflation and wealth is critical for long-term financial success. By incorporating inflation-resistant assets into your portfolio, you can help ensure that your wealth maintains its purchasing power, even as prices rise. The importance of estate planning for wealth preservation. For many wealthy individuals, wealth building is only half the equation. The other half is wealth preservation, which ensures that the wealth you've built is protected and passed down to future generations. Estate planning is a key component of wealth preservation, and it's something that many people overlook until it's too late. Estate planning involves making arrangements for how your assets will be distributed after your death. This includes writing a will, setting up trusts, and planning for taxes. Without proper estate planning, your wealth may not be distributed according to your wishes, and it could be significantly reduced by taxes and legal fees. One of the primary goals of estate planning is to minimize the tax burden on your heirs. Depending on where you live, estate taxes can take a large percentage of your assets upon your death. By creating a plan that takes these taxes into account, you can ensure that more of your wealth is passed on to your beneficiaries. Trusts are a popular tool for estate planning because they allow you to control how and when your assets are distributed. For example, if you have young children, you might set up a trust that provides them with a steady income as they reach certain milestones, such as graduating from college or turning a certain age. Trusts can also protect your assets from creditors or lawsuits, ensuring that your wealth remains intact. Another critical component of estate planning is life insurance. Life insurance can provide your family with financial security in the event of your death, covering expenses such as funeral costs, debts, and living expenses. For those with significant wealth, life insurance can also be used as a tool for paying estate taxes, allowing your heirs to inherit your assets without having to sell them to cover tax bills. Estate planning is about more than just distributing your assets. It's about ensuring that your financial legacy is preserved and that your family is taken care of after you're gone. By creating a comprehensive estate plan, you can protect your wealth and ensure that it benefits future generations. The power of financial independence. Retire early, FIRE. The FIRE movement, financial independence, retire early, has gained significant popularity in recent years as more people seek to break free from traditional employment and achieve financial freedom at a younger age. The core principle of FIRE is to save and invest aggressively during your working years so that you can live off your investments and retire well before the traditional retirement age. Achieving FIRE requires a combination of frugality, smart investing, and a strong commitment to living below your means. People who pursue FIRE often save 50% or more of their income, significantly reducing their expenses and maximizing their investments. The idea is to accumulate enough wealth so that the income generated from your investments can cover your living expenses indefinitely. Here's how you can adopt the principles of the FIRE movement to accelerate your wealth-building journey. 1. Aggressive savings. FIRE proponents often aim to save as much of their income as possible, sometimes as much as 70%. This may involve cutting back on non-essential expenses, such as dining out, entertainment, and travel, and prioritizing saving and investing. 2. Investing for the long term. In order to retire early, it's important to invest in assets that generate long-term returns, such as stocks, bonds, or real estate. Many people in the FIRE movement rely on low-cost index funds, which provide broad market exposure and steady growth over time. 3. Creating multiple income streams. While saving and investing are critical components of FIRE, many people also focus on creating multiple streams of income to accelerate their journey to financial independence. This could involve starting a side business, investing in rental properties, or building a portfolio of dividend-paying stocks. 4. Lean FIRE versus fat FIRE. There are different variations of FIRE depending on how much you want to spend in retirement. Lean FIRE involves living a minimalist lifestyle with lower expenses, while Fat FIRE allows for a more comfortable lifestyle with higher spending. Your FIRE strategy will depend on your personal goals and financial situation. The FIRE movement offers an alternative path to traditional retirement planning, and it's an exciting way for people to take control of their financial future. Whether you're aiming to retire in your 30s or 40s, or simply want to achieve financial independence at a younger age, the principles of FIRE can help you reach your goals faster. Building generational wealth. Generational wealth refers to wealth that is passed down from one generation to the next. For many, building generational wealth is a long-term goal that ensures financial security for their children, grandchildren, and beyond. However, building and maintaining generational wealth requires careful planning, strategic investing, and education. The first step in building generational wealth is to focus on accumulating assets that can grow and be passed down. This might include real estate, a family business, stocks and bonds, or even intellectual property like patents or royalties. The key is to invest in assets that will appreciate over time and provide income for future generations. However, building wealth is only half the battle. Preserving it is just as important. Many families who build wealth lose it within a few generations due to poor financial management, lack of education, or excessive spending. To avoid this, it's crucial to teach your heirs about the principles of wealth management and financial literacy. This ensures that they are equipped to handle the responsibility of managing and growing the wealth you've built. Here are a few strategies for building and maintaining generational wealth. 1. Create a financial education legacy. Teach your children and grandchildren about money, saving, investing, and the value of hard work. Financial education is one of the most important gifts you can pass on to ensure that the wealth you've built will be managed wisely. 2. Establish a trust. Trusts are an effective way to pass on wealth while maintaining control over how and when it's distributed. Trusts can also help protect your assets from creditors, lawsuits, and taxes, ensuring that your heirs receive the maximum benefit. 3. Diversify your investments. As we've discussed, diversification is critical for protecting and growing wealth. By spreading your investments across different asset classes, industries, and geographic regions, you reduce the risk of losing a significant portion of your wealth due to market fluctuations. 4. Create a succession plan. If you own a family business, creating a succession plan is crucial for ensuring that the business continues to thrive after you're gone. This might involve training the next generation to take over leadership roles or setting up professional management to run the business on behalf of your heirs. 5. Estate planning and tax strategies. Without proper estate planning, your heirs could lose a significant portion of their inheritance to taxes. Work with a financial advisor or estate planner to create a tax-efficient plan for passing on your assets. Building generational wealth takes time, patience, and discipline. By focusing on long-term investments, educating your heirs, and creating a comprehensive estate plan, you can ensure that your wealth will provide security and opportunity for your family for generations to come. Developing a money mindset for entrepreneurs. Entrepreneurship is one of the most effective ways to build wealth, but it requires a unique money mindset. Unlike employees who earn a steady paycheck, entrepreneurs must learn to navigate the ups and downs of business revenue, manage cash flow, and reinvest profits into growth. The way entrepreneurs think about money can significantly impact the success of their business and their ability to build wealth. One of the most important aspects of an entrepreneur's money mindset is risk tolerance. Building a business involves taking risks, whether it's investing in new products, hiring employees, or expanding into new markets. Entrepreneurs must be willing to take calculated risks while balancing the need for financial stability. Cash flow management is another critical component of an entrepreneur's money mindset. In the early stages of a business, cash flow can be unpredictable, with large expenses and delayed payments from clients. Entrepreneurs need to develop strategies for managing cash flow, such as building a cash reserve, securing lines of credit, and maintaining strong relationships with clients and vendors. Successful entrepreneurs also have a growth mindset when it comes to money. They understand that reinvesting profits back into the business is key to long-term success. This might mean hiring additional staff, investing in marketing, or developing new products. While it can be tempting to take profits out of the business for personal use, reinvesting ensures that the business continues to grow and generate more wealth over time. Finally, entrepreneurs must develop financial resilience. Business ownership can be unpredictable, and there will be times when sales are down or unexpected expenses arise. Having a strong financial foundation, including savings, investments, and backup plans, allows entrepreneurs to weather financial storms and continue building wealth. Entrepreneurs who develop a strong money mindset are better equipped to build successful, sustainable businesses that generate wealth for the long term. Conclusion. We've now explored additional critical areas related to wealth building and financial independence, including the impact of inflation, estate planning, the FIRE movement, and building generational wealth. Each of these topics provides deeper insights into how to protect, grow, and sustain wealth over time. As you continue on your journey to financial independence and wealth building, remember that success is not just about accumulating money. It's about understanding how to make your money work for you, protect it, and pass it on to future generations. Wealth building requires a combination of strategy, mindset, and action, and by mastering these areas, you can achieve lasting financial success. The path to wealth is filled with opportunities for learning, growth, and reflection. Keep refining your financial strategies, stay informed, and maintain a mindset focused on abundance, discipline, and long-term thinking. Part 7. The wealth effect and lifestyle inflation. One of the psychological traps many people fall into as they build wealth is lifestyle inflation. As your income increases, it's tempting to start spending more on luxuries that were previously out of reach. Bigger houses, nicer cars, expensive vacations. This is known as lifestyle inflation, and if you're not careful, it can erode your ability to build long-term wealth. The wealth effect is a phenomenon where people feel wealthier as their assets, like stocks or real estate, increase in value, leading them to spend more, even if their actual disposable income hasn't changed significantly. For example, if the value of your home goes up, you might feel wealthier and justify purchasing an expensive new car or upgrading your lifestyle in other ways. While it's natural to want to enjoy the fruits of your labor, the key to long-term wealth is maintaining financial discipline, even as your income rises. The wealthiest individuals often live far below their means, despite having the resources to indulge in extravagant purchases. By resisting the urge to upgrade your lifestyle with every pay raise, you can continue to save and invest a larger percentage of your income. One way to combat lifestyle inflation is to set firm financial goals that take priority over discretionary spending. For example, if your goal is to save 20% of your income, stick to that percentage regardless of how much your income increases. By automating your savings and investments, you make sure that lifestyle inflation doesn't eat into your wealth-building efforts. Another strategy is to consciously evaluate your spending. Before making a significant purchase, ask yourself if it aligns with your long-term financial goals. Does buying a luxury car bring you closer to financial freedom, or is it a short-term indulgence that will require more maintenance costs down the road? By being mindful of lifestyle inflation, you can enjoy your wealth without compromising your financial future. Leveraging tax strategies for wealth building. One of the most overlooked aspects of wealth building is effective tax planning. Wealthy individuals understand the importance of minimizing taxes to maximize the amount of money they keep. There are several tax strategies that can significantly impact your ability to build wealth over time. 1. Tax-advantaged retirement accounts. Contributing to tax-advantaged retirement accounts, such as 401k, IRAs, and Roth IRAs, is one of the most effective ways to reduce your taxable income while growing your wealth. In a traditional 401k or IRA, your contributions are made pre-tax, which reduces your taxable income for the year. The money then grows tax-deferred until you withdraw it in retirement. In a Roth IRA, you contribute after-tax dollars, but your money grows tax-free, and you won't owe taxes on withdrawals in retirement. 2. Tax loss harvesting. If you invest in the stock market, tax loss harvesting is a strategy that allows you to offset capital gains by selling investments that have declined in value. For example, if you sold a stock at a profit earlier in the year, you can sell another stock at a loss to reduce your taxable gain. This helps you minimize your tax liability while rebalancing your portfolio. 3. Real estate tax deductions. Real estate investors can take advantage of several tax deductions that help reduce their tax liability. These include depreciation, mortgage interest deductions, and property tax deductions. Real estate also allows you to defer capital gains taxes through a 1031 exchange, where you sell one investment property and reinvest the proceeds into another without paying taxes on the gains. 4. Capital gains tax optimization. Long-term capital gains, those from investments held for more than a year, are taxed at a lower rate than ordinary income. By holding your investments for the long term, you can reduce the amount of taxes you owe when you sell. Additionally, understanding when to sell assets to optimize your tax situation can be a key part of your wealth-building strategy. 5. Charitable giving. Donating to charity can provide significant tax benefits, especially if you donate appreciated assets such as stocks. Not only do you avoid paying capital gains taxes on the appreciated value, but you can also deduct the fair market value of the donation from your taxable income. Effective tax planning can have a profound impact on your wealth over time. By working with a financial advisor or tax professional, you can implement strategies to reduce your tax liability and keep more of your money working for you. The emotional side of money and financial well-being. We often talk about wealth building from a practical and strategic standpoint, but there's also an emotional side to money that plays a huge role in financial well-being. How we think and feel about money can influence our spending habits, saving behaviors, and overall relationship with wealth. Understanding the emotional side of money is key to developing healthy financial habits and achieving long-term financial success. Money and self-worth. Many people tie their sense of self-worth to their financial situation. They may feel more valuable or successful when they have a higher income or more material possessions. And conversely, they may feel inadequate when they face financial struggles. It's important to recognize that your self-worth is not determined by your net worth. By detaching your identity from your financial status, you can make more rational and less emotionally driven financial decisions. Money and anxiety. Financial anxiety is common, especially in a world where money plays such a critical role in our day-to-day lives. Whether it's worrying about bills, debt, or unexpected expenses, financial anxiety can be debilitating. One way to reduce financial anxiety is to create a solid financial plan and budget. By knowing exactly where your money is going and having an emergency fund in place, you can reduce the uncertainty and stress that often accompanies financial concerns. Money and relationships. Money is one of the leading causes of tension in relationships, particularly in marriages. Differences in financial values, spending habits, or income disparities can lead to conflict. Open communication about financial goals, spending habits, and budgeting is essential to maintaining a healthy relationship with your partner. By working together to align your financial goals, you can strengthen your relationship and work as a team to build wealth. Scarcity versus abundance mindset. As discussed earlier, the way you think about money, whether from a place of scarcity or abundance, can shape your financial behaviors. Those with a scarcity mindset often feel anxious about not having enough, leading to hoarding or overly conservative financial decisions. On the other hand, an abundance mindset allows you to view money as a tool that flows in and out of your life, helping you make confident decisions that align with your goals. Understanding your emotional relationship with money is key to improving your financial well-being. By cultivating a positive, healthy mindset around money, you can develop habits that support your financial goals and lead to long-term success. The cost of convenience. How automation and consumerism can impact wealth. In our modern world, convenience is king. We live in an age of instant gratification, where everything from groceries to entertainment is just a click away. While the convenience economy offers undeniable benefits, it also presents challenges for those trying to build wealth. Automation, subscription services, and impulsive spending can chip away at your income without you even realizing it. Subscription services. From streaming platforms to meal kits to software tools, subscription services have become a ubiquitous part of modern life. While many of these services offer value, it's easy to accumulate multiple subscriptions that go unused or unnoticed. Over time, these seemingly small monthly fees can add up to hundreds or even thousands of dollars per year. Conduct a regular audit of your subscriptions to ensure you're only paying for services you truly use and value. Convenience spending. The rise of delivery services, online shopping, and one-click purchases has made it easier than ever to spend money impulsively. While the convenience of ordering a meal or buying a product with a single tap is tempting, these small purchases can add up over time, diverting money away from savings and investments. Being mindful of convenience spending and setting a budget for discretionary purchases can help you curb this habit. Buy now, pay later BNPL services. BNPL services allow consumers to split payments into smaller, interest-free installments. While this can make purchases seem more affordable, it can also encourage overspending. Since you're not paying the full amount up front, you may be tempted to buy more than you can afford. BNPL services can also lead to accumulating multiple payments, which can strain your budget if not managed carefully. Automated shopping and spending. Automation can be a powerful tool for saving and investing, but it can also work against you when it comes to spending. Many retailers and services offer automated replenishment options, where products are delivered to your door on a regular schedule. While this is convenient, it can lead to wasteful spending if you're not actively managing what you need and how often you're purchasing. Consider opting out of automated deliveries for non-essential items and review your spending regularly to ensure it aligns with your goals. The convenience economy is designed to make spending easy, but it can also derail your wealth-building efforts if not carefully managed. By being intentional about your spending and staying mindful of where your money is going, you can enjoy the benefits of convenience without sacrificing your financial future. Using data and analytics to improve your financial strategy. One of the most exciting developments in personal finance is the ability to leverage data and analytics to improve financial decision-making. With the rise of financial apps, budgeting tools, and investment platforms, it's easier than ever to track your spending, saving, and investment performance in real time. By using data-driven insights, you can make more informed decisions and optimize your financial strategy. Budgeting apps and spending trackers. Budgeting apps like Mint and AB, You Need a Budget, and Personal Capital allow you to track your income, expenses, and savings goals in real time. These tools give you a clear picture of where your money is going and highlight areas where you might be overspending. By analyzing your spending patterns, you can adjust your budget and allocate more money towards saving and investing. Investment performance metrics. Investment platforms often provide detailed analytics on your portfolio's performance, including metrics like returns, volatility, and asset allocation. By regularly reviewing these metrics, you can ensure that your portfolio is aligned with your risk tolerance and financial goals. Tools like Morningstar, Wealthfront, or robo-advisors also offer recommendations based on your data to help you make more informed investment decisions. Credit score monitoring. Your credit score plays a critical role in your financial health, impacting everything from loan approval to interest rates. Monitoring your credit score through services like Credit Karma or Experian can help you stay on top of your financial obligations and identify any issues early. If your score drops, you can use the data to understand why and take steps to improve it. Data-driven tax strategies. Tax software and financial advisors can use data analytics to identify deductions, credits, and strategies to reduce your tax liability. For example, by analyzing your past tax returns and current financial situation, these tools can recommend tax-efficient ways to structure your investments, such as holding certain assets in tax-advantaged accounts or harvesting tax losses. By using data and analytics to improve your financial strategy, you can make smarter, more informed decisions that align with your long-term goals. These tools provide valuable insights into your financial behavior, allowing you to optimize your spending, saving, and investing habits for maximum results. Conclusion. We've now covered even more aspects of wealth building, touching on how lifestyle inflation, tax strategies, emotional well-being, and leveraging data can all play a crucial role in your financial success. Each of these topics offers valuable insights into how to better manage your money, make informed decisions, and maintain the discipline necessary for long-term wealth creation. Wealth building is about more than just earning money. It's about understanding the underlying factors that influence your financial behaviors and using that knowledge to create a sustainable strategy. By developing the right mindset, using the tools available to you, and staying disciplined in your approach, you can build the financial future you desire. There's always more to learn, and the journey to financial independence is ongoing. Keep educating yourself, stay committed to your goals, and remember that every decision you make today brings you one step closer to long-term financial freedom.